Hello everybody. It's been a couple of months since we last were in front of the camera presenting to you, but it's that time of the year again, at the end of the year, where we do our end of year outlook and the outlook for the year ahead, so in this case 2021. It's nice to be back in front of you. We had really hoped that we would be able to do a presentation in person, but with the COVID rules still in full cry, unfortunately that's not possible. So please bear with us as we do another online presentation. This is a little bit new for me. We're doing something a little bit different to what we've done in the past. I'm looking at the camera instead of looking at all your faces, which is a little bit intimidating, but we'll see how we go. The title of our presentation this time round is Shots and Shoots. Amazing the difference that an O can make in a word. Shots, because maybe the feature of 2021 is that we're all going to be lining up for vaccine shots over the course of the year at some point or other. Shoots, and not because you're going to get shot afterwards, it's because hopefully there are some green shoots to be talking about, especially in our economy. So without further ado, let's tackle the presentation. It's not particularly long, and unfortunately you can't ask questions, which is wonderful for me, but we are very happy obviously to answer questions. If you want to email some through after you've watched this, we can discuss that at the end. So let's just start by putting a few things in context. I think it's always useful just to look back and to take stock of where we've come from. If you have a look at the slide on the screen, this is basically equity returns for the last 3 years. And what you can really see, which is evident from this slide, is that there's actually been very little equity return for the last 3 years, except for the US. And even in the US, we haven't done it in this slide. If you disaggregate the returns into tech or industrials, whatever, largely the returns in the US have come from tech and tech alone. It's only really in the last sort of month or 5 weeks that returns have picked up elsewhere. If you look at the light blue line, it's emerging markets, and suddenly over the 3-year period that we're looking at here, those are positive. But the rest of the markets, even notwithstanding the rally in the last sort of month, are flat or down over that 3-year period. So as much as we focus on SA and how tough it's been, I think it's worth sometimes putting into perspective globally that it's actually been pretty tough globally, except for large US tech shares. And I think sometimes it's just worthwhile bearing that in mind. It hasn't been an easy run. Just to delve into that a little bit further, this is basically the year to date, and then there's 2 charts here. The one on the left is just is the global return just for the year to date, and the one on the right is the JSE and broken down into the different sectors. And again, I think, to reiterate what I've already said, is that the globally returns have been pretty mediocre. If we look at the chart on the left, this is the 100 line here. So the JSE, the FTSE and the Eurostoxx are all negative for the year, and they remain so, even though those returns are only marginally negative. Emerging markets and the S&P are positive, but a lot of that return has actually come in the last month or 5 weeks since the US election. If you look to the right on the JSE, once again, and as I think everybody knows, probably stating the obvious here, but it really has been a tale of 2 cities, or 4 cities if you want to call it like that in terms of the chart. There's some areas that have been extremely weak. There are other areas that have held up a little bit better. So in terms of the areas that have held up, resources, mining has held up very well. It's the best performing sector for the year. On the other hand, as we all know, property has been the worst performing sector, as has financials. And those are really domestic sectors that have borne the brunt of the weakness of COVID and the impact of COVID on our domestic economy. Industrials is somewhere in between. The dark blue, industrials is the red line. It is positive, initially driven by Naspers. The recovery after the sharp sell-off here was driven by Naspers. Funnily enough, Naspers and Prosus have really traded in a broad sideways range since May, and the last little uptick recently has actually been really about domestic shares starting to perform again, and the slightly more positive mood in the country that is coming through at the moment, which we're going to talk about a little bit. This is a chart that I have shown previously, And what this chart really tries to do is to disaggregate returns into their components. So if you think about a total return, it comes from different elements. There's a price movement and there's a dividend. But that price movement is actually comprised of two things, because what makes prices change is, first of all, where the profits are changing, and then secondly, the valuation that you apply to those profits. So what this chart really tries to do is to break those down into the different components and to analyze it. Now, as the heading of this slide says, ordinarily this is not a good picture. Is it different this time? Well, it's always very dangerous to say, is it different this time? Those are probably the most dangerous words in investing parlance. But if we just understand what the chart is saying to us, this block here is essentially the change in profits. Now, ordinarily you want to see profits rising, which then supports higher share prices. What we've seen over the course of this year is profits tumbling because of COVID and the impact that it's had on profitability, but valuation soaring as markets have looked through the temporary weakness created by COVID, and they're looking further out and saying, well, there's a recovery coming down the line. So ordinarily, we would like to see things the opposite way around. We would like to see profits rising and valuations falling, which implies that shares are very cheap and they are a great buy. In this particular instance, profits have tumbled and valuations have soared. But why is it different this time? Well, I think you have to take into account the extraordinary collapse in profits from a once-off event that was outside of the control of many people. So, yes, profits have tumbled and valuations have soared, but that is likely to reverse just as quickly next year as companies essentially as you lap the effect of COVID and you get back into a much more normalized trading environment. So even though this would be a concerning picture, we are not overly concerned about it at this stage, because if you look further ahead, these impacts are going to unwind over the course of 2021. So there's a changing of the guard. I'm sure most of our clients will sympathize with us that we are delighted with the outcome of the US election. In hindsight, the election wasn't close, but during the election it was very close. It was a very tightly fought race, even though in hindsight it's going to prove, well, historians will say, why did everybody think the election was so close? But obviously for those 3 or 4 days over the election period, things could have gone either way. But in November, we really had a huge rally in global markets, not only the JSE, but also in global markets. And that was driven by the change in presidency, and with it, 1 or 2 changes in policy. And secondly, the vaccine news. So as we sit here today, recording this, the UK started vaccinating its population yesterday, which they dubbed V-Day, which is not Victory Day at the end of World War II. It's Vaccine Day to hopefully conquer the virus. So the UK media has made quite a lot of that. But we do have a changing of the guard in the US, and really that has some implications for 2021. So first of all, it does imply a slightly brighter outlook for 2021. Firstly, we have a recovery in global GDP that is largely taken for granted from the point of view that you are recovering from COVID, and you are going to have a much more normal year from a profitability point of view, even though the first quarter could still be quite tricky. Secondly, and we're going to delve into 1 or 2 of these issues a little bit further, is that you're still going to have a very loose monetary policy, and we are going to have more stimulus coming down the line. One of the implications of Biden's win, I think everybody's hoping, it has yet to be confirmed, but everybody certainly feels that Biden is going to be much less confrontational than Trump was, much more diplomatic, and so less trade friction going ahead than what we've had in the past. It's not to say that there's not going to be trade friction. I think the West is on a collision course with China, but I think the manner in which disputes are resolved and which negotiations happen is going to be more cordial. It's going to be more diplomatic, and therefore there will be less volatility in terms of erratic headlines and midnight tweets that send markets veering off one way or the other. Fourthly, there is going to be a resumption of a hunt for yield. Longer serving clients will remember extensively after the financial crisis that there was a long period where there was a hunt for yield, where interest rates remained exceptionally low globally, and investors then searched the world for any income possible. And we see this trend starting to resume again over the course of 21. It's actually already started, but it's going to gather momentum. And then finally, the further implication of Biden's win is the weaker US dollar. The US dollar has actually been weakening for much of the year, but it's going to weaken further. And I think that's really a function of the fact that less trade friction, not more globalization, but a slower pace of deglobalization, if you want to call it like that. I think the world is deglobalizing to some extent, and countries are looking a little bit more inwardly and a little bit more self-servingly. I mean, I think if you even take our example in South Africa here, and what COVID has shown is that a lot of retailers are moving some of their production back to South Africa to shorten lead times, to make themselves more responsive. COVID has shown that sometimes having a long supply chain and a complicated global supply chain can actually be a disadvantage. So I think from that point of view, the world is deglobalizing from where we were, but the pace of deglobalization will slow. The amount of money earmarked for foreign investment in other countries apart from the US will increase. And generally, you're going to see money flowing out of the US and into other currencies, which obviously has positive implications for certainly emerging markets, which we're going to deal with shortly. So it's generally, I think the investment community is delighted that there's a changing of the guard in the US, and even more delighted that Trump has finally agreed to move out and let Biden move in. So let's just deal with one or two of these issues in a little bit more detail. I think the first thing we have to understand is that there is we're in another situation where there's unprecedented monetary conditions. We are drowning in debt in the world, but yet debt has never ever been cheaper. So if you look at these two charts, what they're really trying to show you is on the left we have the US, and on the right we have the UK. The blue line is the debt as a percentage of GDP, and the red line is the 10-year bond yield in each of those respective countries. And you can see that debt to GDP has never been higher in the US. It rose significantly after the financial crisis and then plateaued for the last 10 years. And look at the pace at which it has risen over the COVID crisis, If you look at the UK, obviously debt rose significantly after the financial crisis. There was also a collapse in GDP in the UK. They actually went some way to repairing the over-debted situation over the sort of 10 years since the financial crisis, but obviously now with COVID, that has started to reverse. And in both cases, you've got record low interest rates in both countries. Now, when you have this amount of debt, basically the last thing you want is for interest rates to rise, because that means that you're going to be paying much more interest on all this debt, which is simply unaffordable. So one of the implications of the huge amount of debt that is out there, and there is more coming, because we know that the US is going to unleash another wave of stimulus in the next, I don't know, maybe month. There's obviously negotiations going on at the moment, and numbers bandied around are another $1 trillion. So these levels are going to rise, but the implication is that interest rates are going to stay very low for quite a long time. And the Federal Reserve has even come out and said that despite their mandate on inflation, they are very happy to see inflation and employment getting back to sort of pre-COVID levels before they start tinkering with monetary policy. So from that we can imply that interest rates are going to stay lower for longer. But that basically creates a very supportive global environment, especially for emerging markets. So we have a sort of situation in the world, and after Biden's win, if we start with the diagram on the left, where you essentially start with a position of a reduced trade war risk. So as I said before, we're not saying that the trade war's gone away, What we are saying is that the manner with which disputes are raised and with how countries negotiate with each other is going to be better handled, and I think more predictable going forward. So you start with a reduced trade war risk. You have a situation where foreign direct investment flows start to reverse. You start, if you're having all these trade wars and you're putting tariffs in place and you're concerned that things can escalate and you might suddenly have tariffs on your goods, you're not really going to go and invest in and diversify your supply chain or go and invest in other countries because you're not really quite sure where you stand. But if the rhetoric settles down and the regime becomes more predictable, then you actually are quite happy to go and build that factory in South Africa or Vietnam or wherever it is you want. So foreign direct investment sort of flows reverse. Money gets sucked out of the developed world, Europe and the US, and into largely the emerging world. So that creates weakness in the US dollar, which, remember that currencies are just a seesaw. So if the US dollar is weakening, then the currency on the other side is appreciating in value. So we've already seen the rand appreciate significantly over the course of the last 6 months. It's hard to believe that we got to over 19 to the dollar at the height of the sort of COVID panic. And now we're sitting at a situation where we, as of today, when we're recording this, we are at a situation of 14 Rand 90 to the dollar. Largely where we've traded, we've probably traded in a range between 13.5 and 14.5, 15 for the last 2.5 years. So all that COVID-induced weakness has been reversed. But it's partly because the dollar is weak, not because the rand is necessarily so strong. But it is a benefit for South Africa. So you have then portfolio flows looking to emerging market yields. So this is really what I talked about in the hunt for yield. If you have a situation where developed markets have very, very low interest rates for a long period of time, you are going to start looking for income from elsewhere. I put it in intuition in the last issue, but I haven't repeated the slide here. But we had a table showing the difference between interest rates in various countries and the US. And South Africa, Brazil, Russia really stand out as having exceptionally high yields relative to other countries. 7-8% difference between us and the US. So if you're confident that the currency is going to be stable or appreciating, you're going to start hunting out those yields because the difference in income is so attractive, and especially so if you don't think that you're going to lose that benefit on a weaker currency. So you have portfolio flows looking to buy emerging market bonds. That causes the currency to strengthen a little bit further. Well, you have equities also rising. So, you have money getting sucked into bonds. You have money getting sucked into equities in emerging markets as well. You have emerging market currencies recovering. And that basically feeds back into a positive loop because the currency recovers. If you're sitting in America or Europe, your return is just getting better and better. A, you're getting the extra income, but B, you're getting the extra return from an appreciating currency. So as that circle unfolds and it becomes more mainstream, everybody's saying, oh, well, I'm getting 12, 15% returns from my emerging market bonds. That becomes a momentum trade, a self-fulfilling prophecy, which sucks in more money, and so the cycle continues. Now, emerging markets have really been out of favor for the last 10 years, but if the cycle starts to turn, then really there's a lot of leeway for emerging markets as an asset class to actually have their day in the sun, if you want to call it like that. But everything's got to start with a sort of first step. The other implication of a weaker dollar is that commodity prices tend to rise. So all commodities are priced in US dollars, whether it's gold or iron ore or copper or whatever you want to talk about. And so when the dollar weakens, you tend to find that commodity prices rise to offset the weakness in the dollar. And you can see from the chart on the right that commodity prices are already rising. They've been rising for most of this year, which is maybe contrary to what your intuitive gut would tell you in a weak recessionary type of environment. Why would commodity prices be rising? But they have been rising. And that's obviously also very good for a country like South Africa, because we are a large commodity exporter. And you know, as we record this, iron ore prices are at $145 a ton. They've never ever been this high before. They got to I think $120 a ton last year when the sort of mine dam in Brazil collapsed and a lot of Brazilian production was taken offline. And now we're sitting in a situation where iron ore prices are $145 a ton. And just to remind you, Billiton and Rio Tinto, and to some extent Anglo, not quite the same for Anglo, but their marginal cost of production of iron ore is $14 a ton. So at these kind of levels, really, mining companies are just an absolute printing press. But it's obviously good for the country as a whole. So I've already alluded to this, but you're really having a change in supremacy. So the dollar has been really the only currency of choice for the last couple of years. It's really been a factor of two things: strong US growth in the face of not much growth elsewhere in the world. It's also been a risk reduction trade from the point of view that you had the US fighting with China, which is the other biggest economy in the world. It was the safe place to be in US dollars, especially if you were uncertain as to how things were going to play out. But you can see that if you just look at the chart here, this is quite a long chart. It goes back 30 years because I wanted to highlight some trends to you. But you can see here that the dollar's actually been weakening, the blue line, for the last sort of 6 months. But you can also see quite clearly from this chart that when you have periods of dollar weakness, you have periods when emerging markets perform very well. Because dollar weakness creates the conditions in which emerging markets tend to flourish. And so every time that the dollar's had a period of weakness, you've seen emerging markets actually perform quite well. And the converse also applies. When you have dollar strength, you have emerging markets underperforming. So as I said, we've really had emerging markets underperforming developed markets for the last 8 to 10 years. And the stronger dollar has been one of the factors in that recently. Those trends are starting to unwind. And it bodes well for a general reassessment of the asset class, which is important because obviously when we consider South Africa, and long-term investors will know that we always say when we're talking about the Rand that the Rand, 80% of the Rand's movement has got to do with what's happening in emerging markets generally. 20% has got to do with what's actually happening in this country. And so if the whole global environment is turning a little bit more positive, then as long as we're not the ugliest bride at the ball, there's room for us to shine and to benefit a little bit from the global trend. So I think, just to finish off on this point, we can already start to see some evidence of this coming through in the numbers. So let's just start with the chart on the right. So we often show these charts. This is the amount of foreign investment into South African equities and South African bonds, by foreigners. If you look at the chart on the right, you can see this big outflow period here, which coincided with the downgrade in March and the onset of COVID in sort of April, May. We've had 1 or 2 slightly choppy months, but in the last 2 months, November and December, bond inflows have turned decisively more positive than they've been for really the whole of this year, which is quite encouraging. And I think it really is the very, very first evidence of the hunt for yield in global markets coming back to the fore. So we don't think this is a flash in the pan. We think this is the very first green shoots of what is going to become a multi-year trend of people looking for income, because interest rates are going to stay very low for a long time in the developed world. On equities, the picture hasn't really changed much. And unfortunately, actually in November, the picture was looking much better. There was actually an inflow of money into equities for the first time really since the Ramaphosa period after the Nasrec election in 2017. But on the last day of the month in November, there was a index rebalancing, and we went from sort of being positive for the month to being negative as all the indices were reweighted, and obviously global asset managers and global tracking funds had to reweight their portfolios accordingly. So that rather upset my chart, because I was going to show you that there was a change of trend, and now I can't. But I think if you look deeper into the data, you can actually see that some of the trends are starting to change already, and hopefully we will see this start to manifest itself over the next sort of 3 to 6 months. and that there's a definitive change in appetite for emerging markets. So before we go on to sort of South Africa per se, I think what's really important to sum up on this part of the presentation is that the global environment is turning much more conducive for emerging markets, and South Africa will benefit from that, providing it just keeps on doing the basic, one or two of the basic sort of things right. So let's now talk, first before we do that, let's just sort of summarize what's coming. I think we do have to appreciate that in the next sort of 2 to 3 months, we could still have some quite difficult times. There's a second wave of cases in Europe and obviously the US. The US is really in a very bad way from the cases. I mean, cases are rising, deaths are rising. They really don't seem to have been able to control the outbreak as nearly as successfully as European countries. I think possibly because of a leadership vacuum and a bad example set by President Trump in terms of, hygiene and masks and all that kind of thing. So I think we must brace ourselves for the fact that fourth quarter data and maybe even the first quarter of next year could be weaker than anticipated. But on the other hand, what that's going to do is that's going to encourage more stimulus. So that's why my little pile of money is sitting at the bottom there, is because basically you're going to have another trillions of dollars of money thrown at the problem to ensure that the economy doesn't stagnate and that the recovery continues to take hold. So you're going to have the situation where even though the news flow gets a little bit worse in the short term, you're going to have more money flooding the system, which is going to continue to prop up markets, despite the fact that on the face of it, share prices you would think might be, should be falling. I think there is a risk that there's some volatility in the next couple of months as people react to different data. We had US unemployment numbers last week and they were weak, which I think is a first indication that some of the momentum is running out and that the second wave is slowing down the pace of recovery. But as I said, the reaction to any weakness in data is going to be another wave of stimulus coming through, both from the US Federal Reserve and the Bank of England and the European Central Bank and the Bank of Japan, for that matter, which they did yesterday. So there's going to be more money flowing into the system. We're going to have a situation where global interest rates will remain low for a very long time. I've already spoken about that. But down the line, are we going to see inflation coming? It's a very hard question to answer. But when you have mountains and mountains of money being thrown into economies and money supply rising rapidly, typically it's always ended up at inflation somewhere down the line. So I think we have to be cognizant of the fact that 2, 3, 5 years from now, especially if central banks are going to be so reluctant to raise interest rates, we could have an inflationary problem down the line. And I think it really speaks to one of the key points of our investment philosophy, is that you want to be invested in assets that have the ability to grow with inflation or faster than inflation. So we've had a very benign period of inflation, but don't get sucked into a false sense of security. I think that's the point of that message. And then secondly, what do you do when you're running 10, 12, 14% budget deficits? Where do you get the money from? Typically after big crises, you have tax increases or you have austerity, because at some point you cannot keep running massive deficits and keep printing money without some form of consolidation, some form of belt tightening. So we do think that there's a risk that tax increases rise, or taxes rise across the board. In a lot of different countries, not necessarily just in this country, but across the world, that tax increases rises. But again, we're probably quite a few years away from that, given that the recovery has to take hold. But I think it's something that's worth highlighting, before time to start thinking about, is that inflation and tax increases are probably what we can expect in the years ahead. So let's turn our focus to SA. In the November issue of Intuition, we wrote about the sort of first green shoots of SA, and then the positive trend that we'd seen in markets was all undone in the last week of October, when you had sort of pre-election jitters, and you had the sort of second round of lockdowns being announced across Europe, which sent markets plummeting sort of 7-8% in that last week of October. And then in November, everything obviously turned around. But there's no doubt, in our opinion, that the mood in this country is turning for the better. Now, we don't want to get carried away. We know that there's a huge amount of skepticism out there, and we ourselves are very skeptical. But there's no doubt that at the margin, one or two data points have surprised on the upside. And I think what's important here to look at is high frequency data points to better growth than expected. And that expected is a very important word. We are not saying that we are back at the races. We are not saying that everything's hunky-dory in this country. What we're saying is that there's an expectation that South Africa was sort of down here. The data that's coming out sort of says we're operating at this level. So we're not up here where we might like to be, but the data is better than expected. And when you have a difference between expectation, well, reality and expectation, that's what makes share prices move, and that's what makes a recovery happen, which is what we've seen the first signs of in November. So if you just look at three different metrics that we've got here, we start on the left, we've got the trade, we've got South African exports. Exports are at a record level. We basically exporting, we exported 150 billion rands worth of goods in October. This data is to the end of October. Exports in this country are at a record level. And you can just see what I've basically plotted here is our exports relative to the last 2 years. And you can just see how much higher they are than typically this time, for the last 2 years. We really have had a good export performance. It's been driven by, in part, higher commodity prices, but it's not just commodities that we're exporting. So at the end of the day, even though our imports are very low, which is a sign of sluggish domestic demand, our exports are high, which means that we're actually creating some GDP growth. And obviously, export earnings are important for us. If you look at freight volumes, this is the amount of freight that's transported on our roads and rail and harbours. Currently, this data is to the end of September. I think October. We are down 7 or so % year on year. Now, 7% down over this time last year is not great, and the trend was already quite weak over much of 2019. So it's not as if 2019 was growing on the previous year. But again, relative to what was expected, it shows that the economy is not as dead as what everybody is assuming. Very similar with VAT collections. VAT collections are down 4% year on year, and this data is to the end of September. Now, VAT collections are essentially a nominal number. So if you convert that into a real and take inflation into account, you're probably saying that VAT collections are down sort of 7 or so %, which is very much in line with expectations for GDP for this year. But at one stage, there was an expectation that GDP might fall 9 to 10% this year. And all this data basically points to the fact that, yes, the economy is weak. Yes, we've taken a massive blow from COVID, but actually it's been more resilient than what we have initially expected. And that's come through in various company results as well, which we wrote about in Intuition. So there's room to be positive on where we find ourselves. If we move on to valuations, we always sort of show valuations, and if you look at the chart on the left and you see the PE ratio shooting upwards in the manner that it is doing here, and the peak was at 23 and we're sitting at sort of 22 times at the moment, your initial reaction is to say, oh my goodness, valuations are high, this is not a good time to be buying shares. In the current context, valuations need to be understood. And the PE is rising because profits have plummeted over the course of the year in reaction to COVID. Now, obviously, over the course of 2021, you are going to have a normalized trading year where you don't have lockdowns for anywhere from 6 weeks to 3 months, and those profits are going to normalize, and you're going to have just as quick a recovery in profits as you've had a fall this year, and that valuation is going to normalize. So don't be, it's a little bit similar to the chart that I showed right at the beginning. Don't be concerned or frightened by the fact that the historic PE ratio is at record, near record highs, because it's very misleading. You need to interpret it. If you look at the chart on the right, this is the forward PE. So this is basically saying, what will the PE ratio be in 1 year's time if the current expectations come to fruition? And this is basically a chart of the MSCI index, the MSCI South Africa index, relative to the MSCI Emerging Markets Index. And why we use the MSCI South Africa index is that basically this is just South African shares. It excludes the dual listed shares because those aren't considered to be South African anymore. So yes, it does include Naspers, but it doesn't include the likes of Anglo or Billiton or Richemont or some of the other dual listeds because they're not then considered to be South African. So this is a much more, a much better reflection of where South African shares sit rather than where the JSE sits per se. So as you can see from this chart, this is a relative chart, one versus the other, and when the line is falling, it means that South Africa is underperforming or getting cheaper. And you can basically see that this chart goes back to 2006. South African shares have never ever been this cheap relative to shares in other emerging markets. So if we just take that back into context of what we were saying about emerging markets, and that the global cycle is turning more positive, and that that global cycle, that rising tide can float all boats, South Africa deserves to get its fair share of those kind of flows. But in addition, you have a situation where South African shares are significantly cheaper than foreign shares, than the peer group shares at the moment, which doesn't mean to say we're going to get double our share, but it should really support the fact that we get our share. You know, there's no reason to say, well, we're not going to buy South African shares because they're so expensive. If you're comparing us to Brazil or to Russia or to Asian shares, then we screen well on a valuation grounds, and obviously valuations are important when foreign managers assess these things. I think the other thing that's happened over the course of this year is that there's been a rush to safety. So in the past we've shown charts of cash balances in South Africa, corporates having high cash balances, the banks having high cash balances. This chart on the left basically is taken from ASISA, that's the Association for Savings and Investments in the country, and this basically shows the assets under management of the money market and short-term interest-bearing sectors of the unit trust industry. And if you look at the chart, it goes back sort of 3 or 4 years. Assets under management in these two categories, money markets and sort of essentially cash, has gone from 400 billion up to 700 billion. There's been a race for cash. I mean, everybody's got so defensive. Everybody wants certainty, and that's understandable. 2020 was a very uncertain year. It's been compounded by a lot of retrenchments, a lot of job insecurity, and it's only natural that people wanted to have some security in the investments to protect against any other fallout. But at the same time, you've had this rush towards money market and cash. At this point in time, you are getting the least compensation for holding a very, very defensive asset. So you're holding an asset that has no ability to grow. Interest rates have fallen to absolutely record lows. We haven't had interest rates this low in this country for probably 30 or 40 years, possibly even longer. The chart on the right basically shows you the difference between short-term interest rates, the prime or the repo rate, which is essentially where the banks price their interest rates off, and the dividend yield on the JSE. And you can see back in the past, and this also goes back to the year 2000, if you were in cash and having the comfort and security of cash with no growth, you were actually getting almost 10% more in income than you were getting if you invested in shares on the JSE in terms of the dividend yield. But over the last 20 years, that has basically fallen to zero. The dividend yield is now the same as the cash, is the interest rate on cash, and you are in a situation where the dividend yield is actually depressed at the moment because of COVID and the the fact that a lot of companies have chosen not to pay dividends over this particular year. So you're going to get a faster recovery in the dividend yield in the JSE as companies start to normalize over the course of 2021 and 2022. Interest rates will rise at some point, maybe towards the end of next year or only in 2022. But you are not being compensated for holding cash. And we think that this is an opportunity, we think to switch now and to be very defensive is is shooting yourself in the foot. You're not being compensated at the same time when the mood is changing a little bit for the better. So as always, there's a very schizophrenic outlook in SA. We can sit here and we can paint a very bullish outlook for the country. Equally, we can paint a very bearish outlook for the country. And I think both scenarios are equally plausible, and we can paint them with equal conviction. And if I just want to go through it quickly, I mean, in the bull case, you have a supportive global environment, which is what we've been talking about. You've got a hunt for yield that drives foreign investment. You've got a stable to appreciating currency. You've got stable inflation, so interest rates remain lower for longer. Reforms gradually take hold, which we have seen already. And just on that point, I sort of say here, reforms gradually take hold driven by energy and telecoms. We're currently attending a conference facilitated by JP Morgan in discussions with Eskom. Probably Eskom's never sounded so bullish is not the right word, but positive that they are turning the corner. So it's not evident to the man on the street, but Eskom themselves are confident that maybe by the end of next year, load shedding should largely be a thing of the past. Now, that would be a hugely positive move forward in this country in terms of providing a stable platform for energy and for companies to grow. But you obviously have government tackling the wage bill, and we actually stay here partially because this is another contentious point. Government's outlined a very aggressive push to tackle the wage bill. We don't think that it's going to be achieved completely. We think it's only going to be partially achieved. But partial achievement is better than no achievement. And I think if you adjust one's expectations and don't set your goals too high, that actually partial achievement is still what's significantly better than nothing. But actually, it starts to turn the ship in the right direction. So don't set unrealistic goals for government that they can't achieve. I think you need to temper your expectations a little bit. So fixed investment recovers. There's a gradual recovery in GDP, and the JSE performs well and certainly delivers inflation-beating returns. Given the base that we're coming off and the valuations that we're coming off at the moment. That's the bull case, and that sounds pretty convincing, and we would love to ascribe to that. But equally, if we focus on the bear case, we can paint an equally convincing picture. So despite the supportive global environment, foreigners stay away. They've been burnt in South Africa. They don't see change happening. Asia's more appealing, Brazil's more appealing, and why should I invest in South Africa? I don't need it in my portfolio. There's every chance that can happen. Reforms are slow or non-existent. Let's be fair. We've been waiting for reforms for a long time. We have been disappointed before. Every time you stick your neck out and you want to get excited, it feels like you're getting kicked in the groin because you get disappointed. So there is evidence that reforms are taking place. I think if you scratch beneath the surface, you will see that there's evidence of that. But there's certainly enough vested interest to try and stop the reform process as well. So, it is a possibility. Government fails to break the wage cycle, the debt trap looms, which we've obviously been speaking about, undermining confidence and investment, especially from South African companies. And if South African companies are not investing in their own country, you're not going to get foreign companies investing here. One of the biggest thumbs up for foreign investors is where the South Africans are voting with their own feet and putting their money where their mouth is. So you basically have a stagnation in growth. The rand starts to weaken again. The clamour for offshore assets continues, and the JSE is a tale of two halves. You have global rand hedges that perform well, and you have domestic shares that continue to perform very badly. So, which of those two scenarios is going to play out? Unfortunately, we don't know. We'd like to think the bull case. Sorry, that was a slip of the tongue, but we don't know. And hence, when we come to constructing portfolios, we basically have to take a blended approach and marry the two, because it's as risky to hedge your bets. We think it's as risky to bet completely on the bull case as it is to bet on the bear case. I think, in some probably in reality, what will muddle through is some sort of combination of the two, where you have some reforms, you have some disappointment, but generally we hope that we might start slightly moving in the right direction. But if we try and have a balanced portfolio, what we're really saying is you're going to have some local champions for the bull case. But when we choose local champions, we don't think this is the time to be investing in second-tier companies that are highly geared to success or failure. If you look at the market over the last couple of days, there's been some huge moves in previously bombed out shares, such as sort of PPC or Tongaat. We do hold a few, but we don't feel that this is the time to be abandoning quality companies and chasing speculative shares that may do very well but could equally fail. We think this is the time to be looking at dominant companies in their respective sectors, strong business models, strong balance sheets, so that they are able to withstand tough times if tough times continue, but equally they will benefit if things turn a little bit more positive, and that's really where we want to be. So you might miss out on some of the really eye-watering returns from some really speculative companies, but your risk is significantly reduced as well, which we think is equally important. But on the global side, we continue to advocate some global exposure. The South African story, South Africa is, in the context of the global economy, hasn't changed. We're a small economy. Globally, things are changing. There's industries and technologies out there that we don't have. Obviously, COVID has accelerated the move into green energy. It's accelerated the move into technology. And some of these things we can't really get exposure to locally. So we still think there's a strong case to be made for having an element of global diversification in your portfolio. And how do we achieve that? We achieve it through either a direct offshore portfolio, if the size warrants it. Alternatively, we can invest in our HH Worldwide Fund. We can buy local Rand head shares, which we have in the past, British American Tobaccos and Richemonts and Anheuser-Busch's and the mining shares, which form part of the portfolios anyway. Or we can buy local ETFs such as the Satrix Nasdaq or Satrix ETFs or the Signia ETFs that basically track foreign indices. So there are different ways to achieve an element of offshore exposure in your portfolio. So I think just really to wrap up and to summarize, it has been a very difficult year. We are very grateful for the support that we've had from everybody. We don't take the challenges that we've had this year lightly. But over the course of the year, we've repeatedly told or asked you to be patient, to not make knee-jerk reactions at a crisis time in markets, because quite often that's the very last thing that you should be doing. We are encouraged by the moves of the last sort of six weeks, which definitely show a reversal of trend, and hopefully that vindicates some of our stance that we've taken over the course of this year. We do think that there's evidence that things are improving, but we can't be certain that it's all going to materialize as we would like, and hence the reason for a balanced portfolio. But having had a very, very difficult year, let's hope that 2021 is a slightly better year. I think it could start on a slightly rocky note. I don't think COVID's gone away. It's going to take a long time for the world to get vaccinated. We're probably not going to have sort of sufficient levels of vaccine, even by sort of, June next year. So COVID's not going to go away overnight. It's going to be around with us, and we're going to have to slightly roll with the punches over the next sort of 6 months. But as you've seen this year, markets are forward-looking, and they're going to look increasingly forward, especially if there's signs that some of the reforms in this country are taking hold. So it's been a tough year. Thank you for hanging in there. We are encouraged by what's going on, and let's hope that 2021 is a year where we can build on the momentum that we've had in the last sort of 6 weeks and go forward. Thank you very much. That brings me to the end of the presentation. As I said right at the beginning, I can't sit here and be grilled with 100 questions, which is to my benefit. But if you do have questions, you're welcome to email your financial advisor or myself directly, and we'll endeavor to answer them as best we can. And then finally, it is traditional for us at Christmas time just to have a Christmas draw. for those who attend these presentations, to say thank you for your support, and just to share a little bit of Christmas goodwill. We obviously can't do a Christmas draw in person this year, but we are still going to have a Christmas draw. It's going to be basically via social media, and an entry into the draw is basically to share this presentation on Facebook, and that will basically give you an entry into the draw. It'll all be explained on Facebook, I think, with the release of this presentation, which is outside of my gambit and my technology expertise, but I'm leaving that to my team. So keep an eye out for it. There's some lovely hampers to be won that will ensure that your waistline is in serious need of some repair in the new year. Yeah, so please do that. Finally, let me just say thank you. Wish everybody a safe Christmas. Travel safely if you are traveling. Keep a low profile, and let's hope that 2021 is a year where we can look forward with promise.